Hello and welcome to another episode of Investing with IBD podcast. It's Justin Nielsen, your host, and it is February 28th, 2024 as we are taping this. And joining me as always is Arusha Paris. He is from O'Neill Global Advisors. He's a portfolio manager and analyst over there. And for those of you that are watching this the day that it drops, you might notice a little funny something on the calendar there. It's February 29th for you. It's a leap year. Any leap year plans there, Arusha?
No, I didn't even realize it was leap year until
until I said something. Well, that just goes to show how much you watch your calendar.
That's true.
Well, and hey, look, we've got an extended month, so if you're feeling a little bit cozy with this extra time, pull up a chair and make yourself comfortable because we've got some stories straight from the trading floor of the New York Stock Exchange for you. Joining us now, a first-time guest for us is Jay Woods, Chief Global Strategist at Freedom Capital, and he's also got these CMT letters behind him, Chartered Market Technician. I could say that for Arusha as well, but I just don't want to because I don't want him to get his head bigger. Of course, you might recognize Jay from his appearances on CNBC, Bloomberg. Gosh, he's been all over the place. So, Jay, how are you doing? It's great to have you on here.
I'm doing great. Thanks for having me. I'm excited to be here.
Yeah, awesome. Well, I think you're so in tune with so many of the guests that we've had. You know all of our guests. You're friends with them. You've worked with them for a long time. But I think a lot of our listeners don't really know your story. So tell us how you got started in stocks.
I got started in stocks by, as an 8-year-old, getting 2 shares of IBM from my uncle, who happens to be a famous technician by the name of Ralph Akampora. And he gave me these 2 shares of IBM and said, you just have to do one thing. You have to chart them on a weekly basis. So high, low, close, did this for 2 months. He comes down to visit me. I grew up in Philadelphia. He was in the Bronx. And I go, hey, Uncle Ralph, what am I doing here? And he drew a line under it. And he said, what's it doing? I go, it's going up. And he goes, that's an uptrend, kid. And that was my foray into technical analysis. It didn't really take right away. I went to Fordham University, wanted to go to law school until I needed an internship, and I was blessed to get an internship in the industry, and I was on a trading desk. I wasn't looking at charts. I was looking at traders, and it was yelling and screaming, just like in the 1987 movie Wall Street.
Right.
And that was euphoric. And I had a great team there, a firm called Sherwood Securities that doesn't exist anymore. But that gave me the bug. And then I went back to the charts, and I parlayed that internship to a job on the floor. And I started on the floor in 1992, and I haven't left. My roles have changed. The market share has changed. But to be a part of that NYSE community, as long as I have, has been the greatest blessing in my life. And the life lessons I continue to learn to this day have been invaluable.
So, talking about lessons, what were some of the biggest lessons you learned while working on the floor?
Well, the floor, I learned how to get lunch. I learned how to take orders. It was a different world in 1992. Our training on the floor, you don't do this anymore with human resources, but the training was like the Karate Kid movie, the good one, the one with not the Will Smith version, but the 80s Macho Elizabeth Shue version. Well, I talk to young kids and they don't know that version.
That's true. That's true. Yes.
Yeah. So, my training of waxing the car and painting the fence was get lunch for these 10 different brokers and these 10 different stocks with these 10 different attitudes and get it right. Because if you can't get the lunch right, how on earth are you eventually going to trade in a crowd with 10 different personalities, with 10 different firms and 10 different stocks? And if you can't handle lunch, you're not going to be handled a trading crowd. So that was my foray into it. You spend years in college, you come out, and you're like, whoa. But that community, the way they taught you, the way they brought you up, you learned the hard way, but you paid your dues, and it was fantastic. And I've been there through changes. We started in 8s, then we went to 16s. And then when we went to 16s, the old school guys were out of here. Right? They're cutting half my profits. Then we went to pennies, and another wave left. Technology ramped up. I was able to pivot and embrace the technology. When I got my seat in 1998, I was that young kid that knew how to deal with this stuff, and it flowed. And then the technicals really incorporated into my trading skills. And then I finally did a deep dive studying into that, because when you're trading minute by minute, second by second on the floor, I better know my levels before I get down to that trading floor, so I'm prepared for the day. Now, technicals, if this, then that. And I was always ready to pivot. And then if I had a crowd of 5 hungry buyers in front of me, I knew the stock was going to go up. I could rip the chart up right now, but where do I want to sell? How do I want to handle it? That is the one thing that's remained constant. We've gone to decimalization. We trade by anchored VWAP with Brian Shannon. What he does, if you're trading minute by minute, if you don't know VWAP levels, then you're really behind the eight ball. I was able to evolve, and then after COVID, unfortunately, things changed again, and we lost, to put it in perspective, my firm, Spearleys and Kellogg, was taken over by Goldman Sachs. We had 330 employees in our height of employment in 2005. Because of enhancements to technology, we didn't need to teletype every order. We just zoomed them in. We got rid of the clerical staff. We got rid of the support staff when no one was getting us lunch anymore. We went from 330 people down to 15 by the time Goldman left the business in 2014. I survived. I was able to adapt and have alliances. And yes, Jeff Probst's Survivor was my favorite show from 2000 to 2015. I played a real life game of it, but I was able to evolve. And then after COVID, my firm left the business again. And then I had a chance to pivot. And I was doing some social media stuff on smaller networks like a Yahoo Finance. I had a lot of friends being at the epicenter of the financial media world, being on the floor of the New York Stock Exchange. You meet everyone. All these people on CNBC were my friends. Bob Bazzani asked me to come on air to fill in for Art Cashin once. And my heart just sank. And my firm said no. So when the pivot came, I went to a firm that enabled me to talk not just to customers, not just to people that want to, become financial literate, which I do a lot of, but to talk to media. And that's really taken off. And now I get to work with a great group here at Freedom, where I get to talk to clients, customers, write weekly, and talk about the market and do it on TV with people I've been comfortable with my whole life. It doesn't feel like work. Don't tell them that, but it's fantastic. And I really reinvented myself again. And the technicals now are more long-term, but with technicals, I can go short-term. I would keep this smock on and go into a trading crowd tomorrow if I could. I miss it. I miss the open outcry, but now it's all algorithms and it tends to be slow and boring. So I'm not slow. I'm definitely not boring. So to be able to get out in front and tell a story about different stocks I like, sectors I like, and the market itself, it's taken off, and I'm very happy it has. And, it's been a good day. We'll see what tomorrow brings, because that's the one thing. I hope you never have guests that come on, and you didn't promote me this way, and I thank you for that. This guy's seen it all. That's what's amazing about working at the New York Stock Exchange, amazing about being in the financial industry. You don't know what the next day is going to bring. I didn't know Snowflake was going to trade down 50 after hours today. But now I'm watching levels. I'm watching that 200-day moving average. Does it do what Palo Alto Networks does? Is Nancy Pelosi buying, as I joked with you beforehand? I don't know. But that's what makes it exciting. And to get to talk about it and then share stories, I mean, it's a dream come true.
Yeah. Well, just very quickly, Jay, you're just that whole story, the recollection of reinventing yourself, really reminds me of some of the classic great growth stocks that we have in our model books, where if you think about it, Apple went from computers to iPods to iPhone to iPad to like everything, right? Or Netflix went from DVDs to streaming to original content. You adapt or die, right? You're reinventing. I mean, in many ways, that's what you've done for 20 years. And I mean, it's pretty incredible. I mean, how'd you get that flex? Like when you were in real time, were you thinking like, I better learn this now, or I might lose my career or whatever?
Well, the financial crisis, and you mentioned Netflix. That's a great example of a stock that I thought, oh my God, what are they doing? I want my DVD in my mailbox. This is ridiculous. Talk about missing a huge opportunity to buy a stock. I think that was down like $50 when that announcement came. There have been different pivots, different changes. To me, it's all about relationships. I think those are the most important things. And over the long term, those relationships that I made, that's what helps me get onto television. That's what helps me meet and branch out and create this brand that I guess I've created for myself. But living through the financial crisis, people ask me those questions. How did you adapt? How did you adjust? You stayed off the radar. You just did your job. You didn't cause any problems. You were respected on the floor. I worked my way up the ranks. They have a different hierarchy down there, floor officials, governors, and then whatever I was, a director. And your peers get the vote on you for that. That was the biggest distinguishment of my career, becoming that red stripe, one of 6 people to represent the floor in matters of the floor. So we went down from 330 people to 15, and all those people, they taught me lessons along the way, and I miss them dearly. That was part of my life, and everyone shaped me, some positively, some negatively. Some told me what not to do, how not to be. You take the good, you take the bad, you take them all, and there you have.
There you have the facts of life. No,
there you go.
Well, you know what? So because you saw, some pretty dramatic changes, you mentioned that you got your seat in 1998. So if I remember correctly, was it in like 2000 that the expansion happened to 5 rooms on the NYSE? And then, yeah. So I mean, because I remember when I was there, they had just expanded to the 5th room, and
yes.
The first time I was ever on the floor, and they had expanded to the 5th room, and it was crazy. I mean, they still were using paper, but they had the big, huge tablets that they were carrying around with them.
Yep.
And then you saw it kind of dwindle, the rooms come down. It became a little bit more of a CNBC set than it did a trading floor. So with the algos, you mentioned the algos coming in, the technology and everything like that. How did that change your, I guess, sense of from the open outcry, the psychology, the sweat that you could actually smell, when there was fear in their eyes, to, okay, now it's just all being done by computer?
Well, that's where the technical analysis really came into play, because you had humans in front of you. You could see human behavior. You could hear a buzz on the floor of the New York Stock Exchange. You walk the floor now, you hear humming of computers. You don't know if the Dow's up 200 or down 200. Back then, you knew. You could tell by the attitude, tell by the smell in the room. So the technicals are what always gave me a little advantage. I credit it to why I went from 330 and survived the 15. I was always one of the top producers. I was always somebody people could talk to because they didn't understand the charts. What levels are you looking at, Jay? And I would tell them, technicals is always if this, then that. Yep. So I would get them prepared. If it does this, then be prepared for that. And being on the floor, risk management, which is always job number 1, job number 2, and job number 3. Job number 4 is lunch, but job number 1, 2, and 3 is risk management. Technical analysis is the perfect tool for that, because if something changes, you have to change. I'm not going to just watch the computer screen and get run over because something broke out above a level, or we had a little cross from oversold to just back above 30 on the RSI, where you can use Bollinger Bands. I used every little indicator, anything that I thought gave me an edge. But the technicals are what really helped me explode my career from a trader and made myself more relevant to the trading community, because not everyone understood this. And I had a good understanding, good grasp, and I could talk about it in a way that was relatable. Too many people come on, and I could do it too. I could talk about Ichimoku Cloud and GAN and Fibonacci levels all you want. You want to go there, let's go there. But I realize when you're talking to people, when I do these shows, I do it for an audience of 1. That's my mother. If my mother can understand what I'm talking about, I'm doing a good job. I know you guys can understand it, but I want a general audience to have an idea. Okay, we want to buy it. If it does this is how we do it. This is how we manage risk, and then make the trade their own. I'm not here to give advice and then, get yelled at for being wrong or praised for being right. I want people to know the setup, what they're getting into, and how they should play it once they do, but knowing first and foremost, manage risk. And maybe that made me a very boring person, a scary person, because when I bought something, I think of the downside before I think of the upside. Am I going to cost average into this trade? When am I going to cut bait? There are so many different structured products and stocks you can trade. Don't get married to one. And too many people did. And I saw too many people blow up over the years.
Yeah. And I got to credit your Uncle Ralph, because he is such a genius in terms of keeping a lot of the things simple. And for those people that don't know, Ralph Akampor, of course, is he's the one that kind of started the CMT program, the chartered market technician. And, when he was on our show not too long ago, I mean, it was like, hey, is it in an uptrend or not? Are there higher lows? Are there higher highs? It's, sometimes just that simple. So very, very good stuff. Arusha, what did you have?
Yeah, well, first, Ralph is the godfather. So
Right.
He's also my godfather. So does that make me technical analysis? I don't know.
Yeah.
But Jay, talking about the indicators, after you learn, because especially going through the CMT program, you learn about tons and tons of different indicators, and they're all super cool. But how did you evolve? Did you find yourself after using them a number of years that you kept them, or did you reduce and try to simplify? How did you evolve during your
Oh no,
trading career?
I keep evolving with those
Hmm.
indicators. I try to keep it simple. So I was blessed when I studied for my CMT exam. Guess where I was? I was on the floor of the New York Stock Exchange.
Wow.
Guess what I did? I was a market maker. I had access to buy and sell stock like no one did. It wasn't really my money, but I treated it like it was. And I would buy a stock based on we're studying Bollinger Bands today. Okay, it just broke above the midline of the Bollinger Band. It's out of the
That's
Bollinger Band,
awesome.
coming
Wow.
back in. I would test different indicators every single day, one to help me study for the exam, and two, put it to work. That's the only way you really learn, is if you kind of put it to work. So paper trade, write notes as you're doing these indicators. The indicators that work for me, the simplest ones, are MACD crossovers with their RSI levels, especially when we're oversold. We go to, when we're oversold and we go back, we're oversold, we go back below 70, I probably want to sell it. Oversold doesn't mean you have to sell the stock. It means it may be getting a little toppy here or trend sideways for a little while. So those are the simple ones. Moving averages and VWAP trading. My relationship with Brian Shannon started at a CMT event. I brought him to the floor of the New York Stock Exchange when I was on a panel, and I said the biggest change in the industry is people don't care about price. When they come in and they ask me, Jay, how's IBM look this morning? They don't care if it's down $2.
Yeah.
They want to know the volume. Oh, 20,000 shares, here's 2,000 shares to buy. I just want to be 10% of the volume. So I brought Brian down, and he sat with me as we opened IBM, ironically enough, and he was floored that all they cared about was volume. Everyone was volume weighted average price. And, I will take a little credit. Brian said nice things about me in his book. I was part of the inspiration for him to write that second book, which he had to do because he was onto something so big.
Yeah.
So any day trader, swing trader that's not using average volume weighted price, then they're missing out, because that's what everyone does. And the thing that scares me, because only price pays, is when I was trading on the floor, your job wasn't to be average. Your job was to do very well. I didn't go to school to be average, but the way people execute stock, if they're average, or God forbid they beat it by a penny, you did a great job. You're getting rewarded with more order flow. It's hard for me to fathom, but that's the way it is. And so if you don't know your VWAP levels and you're not following that, you're missing out on what's really happening behind the scenes. And then algorithmic trading. Look at stocks that stop to the penny on 50-day and 200-day moving averages. Floors me that it's happening. Look at Apple this week. It rallied on the news that they're not making a car. Don't get me started. They were never making a car. But it rallied on that news. Where did it rally up to? A flattening 200-day moving average to the penny. And then it came in. Tell me that's not algos behind the scenes.
That's amazing.
Yeah, absolutely. Well, when we come back, we're going to talk a little bit more about the macro side of things, since we've kind of covered some of the technical parts. So stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Paris, who joins me every week. He is a portfolio manager and analyst at O'Neill Global Advisors. And our special guest this week is Jay Woods. He's chief strategist, market strategist over at Freedom Capital Markets. And, he's been on the floor of the exchange for a long time. He's seen a lot, but as he mentioned, he hasn't seen it all. So let's talk a little bit. We've been chatting about charts and the psychology and everything. Let's kind of step a little bit back and get your perspective on the markets and kind of that macro element, because so many people, it seems like, have been paying attention to interest rates and inflation, and everyone started turning into the macro expert. I mean, Joe Fahmy kind of jokes all the time, when everyone's looking at macro, that's when you're in a lot of trouble. So what's your take on the macro? How important is it? And we've got a PCE report that's probably going to be dropping at the same time as this podcast.
Yeah.
So that's our next thing that we have to contend with. So what's your take on it all?
Yeah, well, of course it's important, but it doesn't always mean we're going to react as the macro environment suggests we may want to react. I remember coming into all the way back to December that people started calling for 6 rate cuts, which I never understood that. I was always in the 3 to 4 camp. I don't know where those numbers came from. And the S&P was trading at 4,800. And now, and the 10-year was it was 3.75%, 3.75. And now where are we? We're just under 5,100 in the S&P. We're not calling for 6 rate cuts. We're calling for maybe 3, still anxiously awaiting what data will come out, could be the PCE, that says, all right, they've got inflation under control. The soft landing narrative is back on the table, and we can cut a quarter point because our hikes they did the job they were supposed to do. I am just following the price action, and two things had me very interested when we talk about watching, the overall narrative, inflationary narrative, the CPI and the FOMC meeting. The FOMC meeting, when was it? 3 weeks ago at this point, when Powell was talking and they weren't cutting rates, and it didn't look like they're going to cut rates anytime soon. What happened in the market? The S&P 500 sold off 1.5%. What did we do the subsequent 3 days after that? Everyone was looking, oh my God, this is it. They're not going to cut. We slowly made it back, and the 10-year didn't spike, and that is what's important. The 10-year is gradually trading higher, but gradual. So we're not seeing those big volatile moments that's causing the equity market to get jittery. And then let's go to the CPI, which is the one data point that does move markets. I know the PCE, and we'll get to that in a second, is the Fed's preferred inflationary measure, but the CPI moves markets. We've seen pivots. We've seen key reversal days going back to October a year and a half ago, where the CPI was what did it. We were down another 1.5%, and the CPI came in a little hot. People are so, okay, now we don't have to cut rates. We have to now, could they raise rates again? Who knows? But the market got jittery for a day, and then we slowly made it back. And then it was about NVIDIA's earnings. And NVIDIA, is it going to follow Palo Alto Networks? No, it didn't. It did well. And my God, they just continue to crush it on all cylinders. And maybe that saved the market, as I heard somebody say today. I think that's ridiculous. One stock's not going to crush or save the market. It will dictate a move over a few days, but it's not going to be the be all and end all. And then tomorrow, the PCE, the Fed's preferred inflationary gauge. We're looking year over year to go from 2.9 down to 2.8. Continued progress. Overall, on the inflationary front, these data points, CPI, PPI, PCE, they've all trended lower. When they've come in hotter, the overall trend is still trending down. So we're still landing this plane, but we're not doing it as quickly as the 6 rate cut camp would like us to do so. But the S&P 500 is making a new high every single time these numbers come in a little hotter than expected. I'll follow price action, and yes, I'll be nervous at 8:30 when this number comes in. If it comes in hotter than expected, what are we going to do? Sell off 1.5%? Well, we kind of have that built in based on FOMC and CPI. Will we go down 2%? We haven't had a 2% drop yet in the S&P 500 in 85 days. That is a pretty long time. I think it was Bespoke that had a stat since like 1970. We've had very few days over 70, only 5 times where we've gone 100 days without a 2% pullback in the S&P 500. It's coming. I mean, but we're streaking right now. Let's enjoy it. But this economic data, yeah, it's going to make headlines because there's nothing else going on. We're 90% done earnings season coming into this week. So the catalyst that can take us higher, is it the PCE? I don't know. I don't know what the next catalyst is to take us higher. So I'm in the camp that we may have peaked out for the near term. Seasonally, you look at it, and Ryan Dietrich had a great tweet, which I retweeted this morning. We are in that presidential cycle where we should pull back. We've had a tremendous run. Let's bring it back. And then what has led over the last 3 months? This is the thing that shocks people. You go back 3 months, the S&P 500 is up 11%. The Dow's up 10%. NASDAQ Composite up 12.28%. NASDAQ 100 up 12.25%. The Russell 2000 up 14.29%. It is still leading right now, and people don't believe it. They're so focused on these 7 stocks. That narrative has passed us on. There are great stocks there. I mean, NVIDIA, Meta, my God. But right now, we're going to look for inflationary numbers tomorrow. If they come in cooler, then maybe we'll talk about, hey, let's put the June definite cut on the table, and May it could happen as well. I don't know, but it's going to be interesting to see. It's going to be interesting how the market reacts. And a pullback, to me, I kind of expected, and we have levels technically where the market should get buyers. And we've seen it down 1.5% twice now. And then you look at where we've come from, maybe psychologically 5,000 is a new floor and not the ceiling. It didn't really last as a ceiling very long. And then you've got rising 50-day moving averages, uptrend lines. These are all normal things. So a 5% retracement, I don't think that's a big call to make. I think that's normal market behavior. But the way the market is trending, the seasonal factors, we should get some sort of pullback. We should get it soon. And maybe the PCE is the catalyst for that tomorrow.
Now, Jay, in many ways, this has been kind of a lockout rally. What's kind of the sentiment that you've heard, after talking to so many people over the last few months? How was that sentiment during that time as the market just kept crawling up?
The sentiment's frustration. And those are some of the toughest markets as a trader to trade, because you're seeing the data points, you're reading the headlines, and you're discounting price action, and it doesn't make sense. Why did we only sell off one day 1.5%, then one day 1.5%? Where's the follow through? This doesn't make sense to me. But underneath the surface, the breadth has been mixed. But the stocks that make up the Russell, 49% of the Russell is made up of the XLI, the XL. I'm missing my XL.
Maybe.
XLF.
It's industrial, it's healthcare, and it's
XLV.
finance. The regionals have held it back. But in the healthcare space, biotech's a big part of that. And guess what just broke out 2 days ago? Biotech. So the surface rotation's happening. And here's a fun stat for you. A week ago, 2 weeks ago today being Thursday when this airs, guess what? 10 of 11 sectors in the S&P Select ETF sectors were up. One sector was down. It was technology. That, to me, says something has changed. Technology was down and everything was up. Okay, the market didn't really skyrocket because technology is so heavy weighted in the S&P 500. The Dow stocks in the technology sector were down point-wise. It hurt us. I think UNH may have been down that day too, the biggest weighting in the Dow. But overall, 10 of 11 sectors up. It's not technology. Something's changed. And I want to be part of that change. So I look at materials breaking out. I look at industrials already broken out, healthcare breaking out, biotech. There are some strong things. And yes, this is technical. Fundamentally, nothing's really changed. Nothing has changed. We're still higher for longer. We've absorbed it. And maybe this is the new normal. People have to put an asterisk by COVID and forget it happened. I'm sorry. We had the greatest rally during a pandemic, which makes no sense when you say that out loud.
Right,
Rally during the pandemic.
With the greatest amount of uncertainty.
Yes, it was panic. I didn't know if I would, humans would ever come back to this building behind me. I did not know that. But we rallied and it got a little too euphoric. Now what we're seeing are retracements, beautiful saucer bottoms. We already saw Microsoft rebound, go roundabout, break out. NVIDIA, boom, it's way ahead of the game. But stocks that took a little while to round out are rounding out and breaking out. I like that. And then stocks that have been dogs. Look at Pfizer. Look at Bristol Myers, J&J. They stopped going down. Stop going down is very important. And now maybe they base, maybe they take another leg lower. I don't know. But I don't think this economic data point that's going to come out or anything in the next few weeks ahead of the FOMC meeting are going to scare people to a point where this bull market run is over. I think it's going to, do what we do when we run very far, very fast. We kind of take a break and we regroup. And then the regroup is probably going to go in the existence of the trend. The trend is higher and the trend is broadening. I'm very bullish on that. I don't think it's going to run away from us, but we're going to have opportunities to buy, and that's a great thing.
Do you think what we're looking at here with the sector rotation, you brought up the strength in the Russell 2000, and I mean, we were having this discussion a couple days ago, and the Russell just got stronger, in the meantime. But do you think this is more of a rotation, money coming from the Magnificent Seven? I mean, the Apple and Alphabet are not looking so magnificent anymore. But do you think the money's coming from there into these areas, or is this more complementary? Like, hey, this is more back to the lift all boats that we just haven't seen as much because it's been dominated by Magnificent Seven.
Well, we're not lifting all boats. There's no euphoria. Sentiment is weak. Traders are puzzled. I don't sense that. I think this is clearly a rotation. I think that example where technology is down and the other 10 sectors are up Money's just rotating out of technology into these sectors. You look at some of those Mag 7 names, Tesla, it's rallying into downtrends here. It's giving you an opportunity to short it again. The money is coming out of these big names and they're going to different place. Apple is not going anywhere right now. I wouldn't, if I owned it, I wouldn't sell it in panic and get out of the name, but it's not going to lead us. And where is the leadership? And that's what I look for. I don't think it's a tide is going to race off, you run into all boats. But when you look for things, you look for opportunities. The Russell is still 17% off its all-time high. That's an opportunity. It's got something to reverse. You have mean reversion possibilities in some of these dogs. I don't like to buy stocks on mean reversions, but they do happen. And you may see money go into those places. And then the cash on the sidelines. There's a record amount. I think it was $6.5 trillion last time I took a peek on the sidelines. People need to get into this market. Some people are into Bitcoin. We've seen what Bitcoin has been doing now that it's legitimate by the SEC because of its ETFs, and Ethereum looks like it's poised to do the same thing. So there is a reallocation of assets. There is some money on the sidelines coming into this market, but this is not a tide lifts all boats. And we're seeing it through earnings season. Those that do well, they're rewarded. They look at Okta after hours. Let's see if it continues into morning trading. But then those that don't do well, or there's big news like a snowflake, like a Palo Alto Networks, they get punished. And they're in pretty strong sectors from what I can tell. So when Palo gets hit and the other stocks manage they go down in unison, but they start coming back and tell their own stories, that's positive. So I think people are being very selective. And they're picking their spots wisely. And semiconductors and cybersecurity stocks, they're still in early innings, as Dan Ives would definitely tell you. And I agree. This is more of a 1995 moment than a 99, 2000 .com euphoric moment. We're not there. Will we get there? Maybe we do. I hope so. But when we do, I bet you I'll come on your show and I'll be a little bearish if we do.
Well, you let us know when that moment happens, and you've got a spot. We'll
got
it for you. So let's talk a little bit about levels, because you've talked about how important levels are for you. Do you use levels? You mentioned some like 5,000 for the S&P 500. Are you using levels that much for the for the indexes, or are you talking more individual stocks? Yeah. So
no, I use levels for everything. I mean, the first thing you do when you mention a symbol I don't know anything about it, I punch in the symbol, I look at the chart. The chart tells the story. Levels of support and resistance are basic. You say keep it simple. We talked about that in the last segment. Yeah, okay, this is where buyers come in, this is where sellers come in. Okay, every time, Russell 2000 is a perfect example. I don't need a chart to know that it was going sideways for 2 years. It finally broke out. IWM is what we should use for the Russell, if you want to throw that up for the audience here. IWM 200, which is Russell 2000. We don't have a hat for that. We do have an S&P 500 5000 hats. Those big numbers are for hats. They're psychological. They're not specific levels. But in the case of the Russell and the IWM, we broke out of a long neutral range and we went. Then we failed. And a lot of people were calling for bear traps. They called this. No, it didn't happen. But they didn't put it in perspective. They didn't say, wait a second. It was a 27% move from the October 27 low to the late December high. It retraced 8.5%. That's a third. Okay, that's a normal, healthy retracement. And where did it hold? Held at a rising 50-day moving average. Every time it was in that chop zone, that neutral zone, I like to call it chop zone, it was above and below all its moving averages. It's what I call a hot mess. Well, it's kind of got structure to it right now. And from a risk-reward setup, it's great. Use your 50-day, give yourself 2% below just in case. You don't want to use it exactly. But the risk reward setup is favorable to a bullish narrative, especially if the IWM can break above 205, 205.49 I see here. And we know it has room to run. It's a lagging index. So if this broadening is happening, you want to be there. Is it sexy? Hell no. No, I don't want to talk at the bar about stocks in the Russell, unless it's, that happy super fun stock, SMCI,
Right,
that
right,
just,
exactly.
it went up. It's 1.7% of the Russell. Look that one up. When's the last time that happened? There was a
Yeah.
stock during .com. So they're going to graduate to the bigger leagues, and they'll be out of the index, and Celsius will be your number one holding in the Russell, although that should probably get graduate higher. But you don't really talk about one specific stock. You talk about sectors when you talk about the Russell.
Mhm.
And that's why I like this narrative. When I see sectors breaking out that are predominantly involved in this index, it should lead us higher. And use that rising 50-day. We got down, we tested, we held. We got up, we came down. We haven't made the new high. We haven't officially broken out, but we're seeing an ascending triangle, and we're going into an uptrend, I believe. And that's the last of the major indexes that, we can call other indexes major if you like, that haven't gone full circle. Will it go full circle and get that 17% it hasn't gotten to? Probably, but it's not going to happen overnight. It's boring, it's slow, and if the interest rate narrative stays high for longer, you have a fundamental reason why they're not coming for small caps. But when we finally get that cut, who's going to benefit the most? Small caps. So that's how I look at that setup, and that's how I look at levels and support, resistance, floor, ceilings. Something changes, it goes through the floor. All right, risk management. Get out, get back in at another time. It doesn't have to sound so petty and simple, but it really is if you're just managing basic risk. If you want to day trade these things, then we can go into a deeper dive, and we can get our anchored VWAP levels, and we can really have fun with it. But as an analyst now, and not as that day trader, I'm trying to look at the big picture, take that top-down approach. You look at the indexes, then you look at the 11 sectors, then you look at the stocks that are the most dominant in those 11 sectors. So if we're talking energy, I don't know ExxonMobil and I don't know Chevron, that's 45% of the XLE.
Right. Yeah.
That's what moves it. The industrials, the materials, healthcare, they don't have that major player. It's so you need more stocks to participate in those indices for them to rally. It's starting to happen.
Well, let's talk a little bit about financials, because you brought that up earlier. How industrials, financials, and healthcare are 49% of the Russell 2000. And last year, when the whole Silicon Valley Bank thing happened, the regional banks were, I think at the time, maybe 20% of the Russell. So I mean, it really had an effect. I think the makeup now is a little bit less, maybe closer to 15-16% regional banks. But it's interesting that even with the New York Community Bank, kind of rumble, and what that's done to regional banks, because if you pull up KRE, it kind of, hit KRE again. But even despite that, the Russell is still kind of chugging along, even though it's got kind of like that headwind. So is that, maybe talk a little bit about that and what that means to you.
And by the way, Justin, you were spot on with your numbers there. The regional banks were 20%. So kudos to you. It was at the end of the year, because they have been beaten down so much that industrials actually took financials as the number one weighting by a skosh. The regional banks back last March, that was scary. And it was a moment that we kind of seen before. Where did we see that? We saw it in the financial crisis. It really reminded me, brought me back to that, because you're seeing banks fail, and they were shooting first and asking questions later, and everything was getting hammered. For us, it's an opportunity. You're like, okay, why is Comerica getting hurt? They're okay. Key Bank didn't deserve this treatment, but they just shot it. And then it was, I don't remember the one bank. There were two banks that got hit one day. One came out and said, no, our balance sheet is fine. We had more deposits this month. It went up and another one went down. And all of a sudden they started to say, all right, let's look at them individually. And they stopped taking them all down. Just like the tide lifts all boats, the tide went out to sea and the regional banks went down with them. And then they started a slow process of bottoming. And then we got another little scare recently, and we sold off a bit more. We haven't made that full roundabout. It's going to take a little while longer, because there still seem to be problems there. I am not the fundamental deep dive regional bank guy to have on your show to say which banks are going to be facing problems, mortgage crises, all these things. But technically, there's something that isn't right. They haven't broken back out. The financials that are winning, look at Goldman Sachs, look at JP Morgan, look at Morgan Stanley, look at your Visas and your MasterCards of the world. Wow. These are strong uptrend strong breakouts, and we're still waiting on some of them. Goldman is ready to go up 5 today. That's where I think the strength is. And the regionals, they may still take some time to come back, and there still may be another one or two that have some real estate issues going forward. So if the regionals were in play right now, yes, that Russell would be a lot higher than it is. But thankfully, there's enough within the index, minus the regionals, that are doing the heavy lifting, keeping us in that near-term uptrend, hoping to break us out. Maybe the regionals help break us out. They report earlier than everybody else, so that cycle will start in about 4 to 5 weeks.
Yeah, and to end the segment, Jay, thoughts on Amazon going into the Dow and Uber into transports?
Right.
All right. I am a geek when it comes to the history of the Dow and what stocks were in it. The first thing I did when I got my job, we had Wall Street journals, newspapers. We'd open, we'd read them. And I memorized the 30 Dow stocks and Bethlehem Steel and Woolworths, letter Z.
Yeah.
These were the 30 most important stocks. And then they put Walgreens Boots Alliance into the Dow Jones Industrial Average, and I had a conniption. I never understood. I didn't even understand what Boots Alliance was. I thought it was a shoe company. It's a London-based pharmaceutical company, and yeah, the people there hate me because I say this all the time. But the stock didn't make sense. Why not CVS if you're going to go that route? I know CVS, but anyway, I digress. The Dow, they're a little asleep at the wheel. I want to find out who's on this committee. I want to be on this committee. I feel I would add value. So if you have connections, someone in this audience knows, hey, Jay Woods is looking to get on the Dow Jones Industrial Average Committee or the Transportation Average. They put Uber in. This is why indexing is great, because the indexes finally get it right. Yeah. Uber goes in. What's the valuation? $90 billion? What did they kick out? JetBlue, the 6th, 7th biggest airline? Yeah, I mean, maybe it's the 6th that they allowed the Spirit merger to happen, but JetBlue is out. So the index itself is stronger. And if you're in the index, you're going to do better. Amazon, more representative. I know Walmart splitting 3 for 1 probably helped the Dow people make that decision for them. But why did we need Walgreens in there? And yes, there are people out there that have this contrarian view. Well, if it gets kicked out, I want to buy it because they remember GE, they remember ExxonMobil. But there are a lot of dogs that got kicked out. Beth Steel and Woolworth, you bought those when they got kicked out. God bless you, because you have no money left. But Amazon, to me, it belonged in there. It's something everyone knows. A $1.7 trillion company. I prefer my stocks to be at the New York Stock Exchange, but I've gotten over when Cisco and Microsoft got added years ago, and Intel. There are 7 NASDAQ stocks still in it, but that's representative of what we are as a country. And those 30 Dow stocks are just important to me as those 500 S&P 500 stocks. You overlap, and I did this in my newsletter last week, overlap the last 50 years, the Dow and the S&P. I don't know why, but they do mirror each other. It's 30 stocks versus 500, and market cap weighted versus price cap weighted. We can go down that road, but when Amazon got put in, I jumped for joy. It belongs in the index. I can suggest other moves too, but if there's a stock that isn't more emblematic of the American, culture. I mean, who's not influenced every day by Amazon? And then I like stocks in uptrends. This one's got a pretty good one. Talk about stocks that have gone roundabout, finally breaking out. 185 is the all-time high there. I want to see it get there. Someone's been selling a lot of stock lately. It's kind of been the roof on it. But once we get through I'm blanking on the Amazon CEOs, ex-Amazon CEOs.
Jeff
Going
Bezos.
to the job.
Jeff Bezos. Yeah.
How do I forget? I'm getting old.
Well, hey, he's no longer important, right? Now that he retired from his position.
Sold billions of dollars worth of stock. He's resistant. So let's get him out of there. And Uncle Warren is supporting Occidental Petroleum all these years. Yeah. So yes, support resistance do have faces behind them sometimes. And right now, resistance in Amazon has been Bezos. Support in Oxy has been Buffett.
Mm-hmm. So, just I know this is going to be the end of the segment, but I got to ask you because, one of the things that people have been commenting on, and you mentioned this, that, gosh, the weighting now in so few stocks is crazy. And the technology, how important that's become. Well, now the Dow Jones Industrials has Cisco, Intel, Amazon, Apple, Microsoft. I mean, it's starting to look a lot more, technology. I mean, I guess that is the industry now, but what's your kind of feeling on how technology based that index has become?
Yeah, and Salesforce.com, which
Yeah,
just
Salesforce,
reported
right?
earnings.
Yeah.
It's great. Still has good old Big Blue in there, IBM, and IBM looks better than Cisco and an Intel. I'll tell you that much. It they could change it up a little more quickly and be more emblematic of the times, and IBM could have been kicked out and brought back in. But it is important. They have a strong technology base, but the Dow Jones Industrial, it doesn't really mean industrial stocks. Or it would be John Deere, Caterpillar,
Right.
and then some defense as well. No, it's really Dow Jones is just the average of the 30 best stocks that are more representative of the U.S. economy. That's how I look at it. They still call it the industrial average, so they want to change their name, But that to me is still emblematic of what the committee feels are the 30 best stocks. The fact they finally brought Apple in there in 2013, a long time coming. Nvidia, they split their stock last time they got this pricey. I had a feeling that was maybe because it could go into one of these, it could go into the Dow. That is the leader in the, give me NVIDIA, get rid of Intel, fine. Get rid of Cisco, give me anything else. Cisco's done nothing for 20, 25 years. Look at that chart. Maybe
Especially the
Splunk
monthly.
deal will, maybe Splunk will finally put it over the top.
Yeah.
I don't know. And that's a little tongue in cheek. But I love watching the indices. I love price weighted. If you don't follow UNH though, and you follow the Dow, then you're misguided because it's the most expensive, most important stock in the Dow Jones Industrial Average. Is UNH, United Healthcare, the most important stock out there? No, but if you're following the Dow Jones Industrial Average, you better know what it's doing. And then Intel, you don't have to worry about because it can go up. Is Verizon still in the Dow? It is. Like you don't have to worry about it. It's not going anywhere. I skate where the puck is, and the puck is in these leaders that continue to, bring out new technology, enhance and grow. And some of these stocks are a little stagnant. The Dow people will eventually get to them. There's no rush. You don't want to wake them up. They're sleeping. But I'm happy that they brought Amazon in and kicked Walgreens out.
Very good. Well, when we come back, we're going to talk about a little bit more in depth on some of the sector analysis that you started with here into some individual stocks. So stay tuned. We'll be right back. Welcome back to the Investing with IBD podcast. This is Justin Nielsen here, your host, along with Arusha Paris, who joins me every week from O'Neill Global Advisors, and our special guest this week, Jay Woods. He's Chief Market Strategist over at Freedom Capital Markets. And you mentioned that you had a newsletter, Jay. So where's the best place that folks can kind of get some more information on your thoughts on the market on a regular basis?
Yeah, thank you. If they follow me on Twitter, JayWoods3, JAY Woods 3 at Twitter, you can see my pin tweet. Not in my bio. That's a Substack. That's something different. In my pin tweet is the Freedom Capital Markets newsletter. You can click on that, sign up every Monday. It comes to your inbox, and it's very simple. Just keeping it simple. What are we watching this week? So this week we were watching the PCE, a little NVIDIA hangover possibly. And then what earnings are on the docket, what economic data is coming. So this week we'll be talking about stocks like DocuSign and Costco. And it's a fun, quick little read in your inbox, and it gives you perspective of what we're watching every week.
Awesome. Well, let's get into some of the stocks that are on your radar right now. And you mentioned healthcare. XLV, of course, is the sector spider ETF for healthcare, and that's been looking a lot stronger. You mentioned the biomed, biotechs, XBI has been looking strong, but you're kind of going in a little bit of a different direction with HCA. Talk to us a little bit about HCA.
Yeah, I want to thank some of the smart money out there for putting this on my radar. It's something technically that is broken out that I love. It's reversed and broken out, and it looks like it's going to continue to trend higher. But what happened last week? 13F filings came out. Those 13Fs are filed quarterly. They're a delayed indicator. It comes out 45 days after the quarter ends. But two people of interest added them as new position. HCA is now a new position for David Tupper, his Appaloosa fund, and Michael Berry, the famous short seller from the Big Short, his Scion fund. Both took these positions on. And when I see new positions in the 13F filings, I don't really pay too much attention, but I will look into them. And HCA technically, it's got my blessing. Full roundabout, gap up, breakout, flag, go again. Thank you very much. But what does HCA do? Let's look under the hood. Let's tell the fundamental story, because I'm sure that's why these smart money investors are in it. It's employs over 200,000 people based out of Nashville, Tennessee, and it's elder care. It primary focus is elder care. I heard this stat on Josh Brown's show the other day. Josh, a good friend. the next 4 years, more people turn 65 than any other span in our lifetime. This is a growing demographic. What do? They take care of the elder. We're living longer. This is a growth industry. So HCA has got triple blessings for me. It's got my technicals, checkbox number 1. It's got fundamentals, checkbox number 2. And then it's got some smart money. I'll throw that into checkbox number 3. So the risk reward setup is there. The long-term fundamental story is there. And this is what I believe you can buy and put away, because it's going to be very predominant in its field for a long time to come.
Mm-hmm.
Yeah, and it's accelerating revenue, like
right.
for 6 quarters in a row right there.
Yeah.
And also when you look at a monthly chart, all-time highs.
What's better than all-time highs?
Right.
Mm-hmm. And now, do you look at kind of competition, other areas that might kind of disrupt this this stock, or anything like that when you're kind of doing your analysis?
No, I look what else in that sector will benefit. And how about some hip replacement? Stryker, Stryker's a stock that has a great base broken out. And the longer the base, the higher the space. We base sideways for a while. We're just breaking out. To me, this is a name that's had runs in the past, and I believe it's on a nice upward trajectory. It's not going to make headlines. It's not sexy. It's not going to be focused on your financial news networks, but we're focusing on it here for your listeners. And I think the risk reward setup is great. If it fails, if it breaks back below that old resistance level, which should act as support, you get out, you move on. But to me, given the fundamental story, the demographic again, and the healthcare rotation, I think Stryker has a lot of room to run here.
Mm-hmm. And I should mention that I do own a position in this myself. I think I bought that in January before the earnings. So yeah, it's something I'm sitting with for now. And you know what? I think David Keller, when he was on our show, he brought this one up. You mentioned David earlier. So
Jay, you can check the smart money box for Stryker.
Yeah, because David Keller.
Yeah, for David Keller. Not for
David Keller, not for Justin.
Okay.
For goodness sakes. So talk a little bit more about are there any of these other boxes that when you look at the fundamental story, again, a lot of times we look at these numbers at the bottom, you can see that the earnings have been growing, double digit, not huge, but, double digit, 13%, 16%, 15%. And the revenue also in the double digit range, 11% to 12%.
And not trading bulls. Yes, these are things I do look at, but the first thing I'll always do is follow the price action, and then I'll do the dive deeper into it. And once you do that dive, it does check a lot of boxes. And I always I believe it's the Peter Lynch mentality: buy what you know, buy what you use. Well, this is something I may know and use very soon as I age. So I'm getting the stock first, and then maybe the hip replacement or the knee later on in life.
To help fund, the stock profits can be used to help fund the hip replacement.
Exactly.
And on the smart money side, one of the things that we sometimes look at, we have an owners and funds area in the MarketSmith, and we can see that Fidelity Contra Fund, Will Danoff is one of the portfolio managers there that we really like to follow, has a position that is a really huge fund. So even a 0.13% position is something of size there. You can see that. Anything else on Stryker before we move on?
No, I think we kept it simple, and I like to keep it simple. I mean, I could have given you some Fibonacci levels if you want them, but let's move on.
Yeah, let's go ahead and give a preview, because again, you mentioned your newsletter where you go through some stocks that are on your radar, and one of the stocks you're going to be talking about in your newsletter is DocuSign. And it feels like we haven't been talking about DocuSign for a while. This was one of the COVID darlings, 2020, everyone was like, well, gosh, forget these wet signatures, let's go e-signature. And they just really seem to dominate. Everyone was afraid that Adobe was going to eat their lunch, but they really, maintained a leadership position there. So what's your take on DocuSign? Something that's been out of favor.
My take is, from a risk reward point of view, it looks like the setup is a little more favorable for the bulls, and you have an out. You may have to rip this one out of your portfolio immediately if you're playing it for earnings. Take your loss and move on. But given the fact that we have a constructive base, we have a lot to reverse. This thing was in the 200s. We're 300. I mean, that I would never give an upside target like that. But it is trending down. The downtrend's been broken. So 1, it stopped going down. 2, it's basing. Now the base is making higher lows. It's holding above its 200-day moving average. Technically, it reminds me a little of a Carvana, where we saw that same exact thing happen. A lot of fundamentalists hate Carvana, but I'll tell you right now, from a technical point of view, knowing that there was short interest in that one as well, the stock has rallied. I don't know the short interest off the top of my head in DocuSign, but right now the setup is trending above its 200-day moving average. It's flattening, starting to turn up. I think if you get positive reaction to earnings, maybe they guide that this stock can gap. If you're not in it, maybe you want to buy that gap. Put your stops closely when you buy gaps on an opening to like 2.5%, 3% below. But it can run, and it could run quickly. So the setup for DocuSign, to me, risk reward point of view, it is very appetizing, and it may be worth a flyer next week. And I'll focus on it in my newsletter.
And
So
to your
generally
point,
going into earnings, how do you adjust for the risk there? Maybe going with a smaller position if you wanted to buy before earnings, or
I had a strict rule, especially when I was a market maker on the floor. If ICE was one of the stocks I was the market maker for, I would be flat going into earnings every single time. I do not trade stocks for earnings. If I'm a long-term shareholder, I own Google. I'm not even going to care about earnings, because the earnings aren't going to change my mind unless the trend has a major change. So if I believe it's a long-term holding, then I don't worry about earnings. I'm not trading it for earnings. If I want to take a little bit more risk on, like in a DocuSign, I'm not recommending anyone do this. But if you do, the parameters are there. And if it fails, get out. Do not make this a long-term investment. This is a trade opportunity. So I wouldn't recommend buying it into earnings. I will chase a gap. I love gaps. I mean, if you want to go, we can do a whole special on trading gaps. Those things are important to me. But right now, seeing that something has changed, it's got my interest, and it's worth talking about. It's worth focusing on. And if someone wants to take a shot, know the risk reward. I think the setup is there, that the risk outweighs the reward outweighs the risk in this case.
Yeah. And that's such a key point. You brought up risk management as being rule number 1, 2, and 3. And if you can keep that small, and again, you've got a lot of room to potentially recover. You can be wrong a lot of times if you keep that, if you keep your risk small and your reward potential large. So, I mean, it seems like an easy.
I'm wrong all the time, but
right.
You want to keep things simple. This goes back to Alan Shaw level 2 CMT class I took in 1993. Four things, and I don't know where he stole this from, but I credit Alan, the late Alan Shaw. 4 things happen when you get into a trade as a trader, and I've seen them all. We've all seen them all. You have a small gain and a small loss. These are normal things. You can have a big gain, that's the goal, and you can have a big loss. If you're going to survive in this industry, you got to avoid one thing, avoid the big loss. Check your ego at the door. I got that small loss. I'm getting out. Maybe I would have been right. Maybe this could be an investment over time, but avoid the big loss and live to play another day. Right. That is how every trader, day trader, swing trader, long-term trader, if you're putting too much allocation into one asset and you are going to take the big loss, guess what? You're not going to be able to put it anywhere else. So you take that small loss, you move on to something else. There are 6,000 different asset classes, ETFs, equity you can trade. They keep coming out with new ones every single day. Don't get married to this DocuSign because the risk reward setup was good. And, oh, crap, I missed it. Well, I'll cost average into it. Or, no, your game plan is your game plan, and a little loss is going to happen. And yes, it stinks when they do. But if you can leave the behavioral and the ego at the door and you take that little loss, you move on. You can yell and scream at me if I'm the reason you got into this trade. That's fine. It'd be like I'm home. And, everything, you just move on to the next idea. There are always ideas out there. That's what's great about the stock market.
Yeah. Well, hey, Jay, it was such a pleasure having you. Again, for those that want to kind of check out some of this stuff, go to @JWoods, the number 3 on X, formerly known as Twitter. You can find him there, some pinned tweets that'll get you to his newsletter that he does as the chief global strategist for Freedom Capital Markets. So, Jay, once again, pleasure having you on. I can't believe we didn't do this sooner. So we'll definitely have you on again. It was a really great time.
This was fun. Joe Palmy said it was going to be a nightmare from hell, but no, we really enjoyed this.
Yeah, don't listen to Joe.
Yeah, we don't like that.
Joe says a lot of things. So,
no, Joe, nothing but peace and love from Joe. He's a big fan, as am I.
Yeah, great having you, Jay. Take care. That's going to wrap it up for us this week. Please join us next week. We're going to have Scott Sinclair, one of our favorites. He, of course, is the senior. He's what? Arusha's old job. What was your job? The head of the premium products. So he's got some stuff to talk about because we've got our new product Market Surge coming out. Kind of replacing Market Smith. So he's going to talk about a lot of the things that are going on there. So we can't wait to hear all of the details from Scott Sinclair. So hope you join us for that next week. Hope you all have a great leap day. And that'll wrap it up for us. Thanks for watching. We'll see you next time.